All right. Welcome to today's live session with me, Craig, and Richard Bailey, our head of training here at Axia Futures. We're going to start in just a few minutes. I'm going to give some extra time to anyone who's still arriving and tuning in. So as you're arriving, I think I'll ask a couple questions just to kick the ball off here, just to get things rolling. But the question I have for you is, because today's session is all about trading statistics and mastering trading statistics, just pop into the chat a yes if you are actively tracking your trading statistics and actually monitoring and seeing what stats are improving and you're working on, and put a no if that's something that you're not currently doing and maybe it's something that you're wanting to look at more in the future. So I see in the chat we've got a yes from Nico. Thomas says yes. Gerben, Pete, yes. Zach, not really. Horace, yes. Giorgio, I'm seeing quite a few yeses. Jordan, David, Julius, Isaac attempting to. Okay, quite a few people tracking their statistics. All right, so put into the chat next, what is your favorite or the number one trading statistic that you watch the most? So let me know, what are you currently tracking? Is it things like something like win rate? Is it your time in trade? So I see, there we go. S. Roberts, time in trade. Anandan, drawdown. Burden, reward factor. Risk reward, expectancy. Win rate, expectancy, win rate, and risk reward. Win rate, profit factor, risk reward. So I'm seeing quite a bit of risk reward, win rates, expectancy, profit factor, MAE. Okay, cool. So interesting to see that what the distribution is there around the stats. I think you're going to gain quite an interesting insight on, especially from Richard when he covers win rates. So, okay, interesting stuff. So today's session, what you're going to hear about is how to interpret your trading stats and use these to boost your trading. The truth about things like risk reward, win rates, and other metrics, key metrics that actually matter, and especially at different stages of your trading career. So certain stats and metrics come more into play and out of play at different stages. A breakdown of how traders at Axia Futures. So if you're not aware, we have floors in London, Poland, Cyprus. You'll hear about how they perform, especially over this last month, when and how to start using leverage and where you should be applying yourself at different points in your career, and a step-by-step case study breaking down a trade that was executed in the gold market, and a whole lot more. So as I said, my name is Craig. I'm with the Axia team. We're going to kick it off. I think that's given enough time for any latecomers to come along. So what I will do, if you can see my screen, I don't think you can actually see my screen right now, but you should be able to see my screen now. Just give me a quick yes if that's coming through. All right, you can see my screen. Yes, okay, fantastic. Thank you, guys. If you're only entering it now, then you're okay. It's cool. All right. So just take a moment to read this quick disclaimer. This covers that this is not, financial advice. This is for educational purposes. So, and while you're reading that, I'll note that it is set 4 minutes past the hour. It is the 22nd of August. This is live. And if you aren't able to stay the whole way through and you have to shoot off for any reason, we will send out a replay. So we often get questions about that. So if that's on your mind, then I should cover that. All right. So why mastering trading statistics? Why are we interested in mastering trading statistics? Well, many traders struggle to accurately assess their performance, and they fixate on one or two statistics like we heard in the chat now, win rates and risk reward. And sometimes focusing on just a few metrics too much can lead to following flawed strategies and a lot of frustration. So what actually matters? What are traders who are actually performing really doing? So we thought, let's share with you some of these statistics and performance metrics behind the traders here at Axia Futures. So what you're going to learn about is the truth about win rates, and especially like how some traders in our team have win rates that are vastly below 50%, but still way outperform above average against many other traders, and what your metrics should look like at different stages of your trading career. You'll see this past month's stats about analysis of the traders on our team, and a whole lot more, and a case study breaking down a gold breakout trade and how to trade a high volume event without directly trading the event itself. So why this trade is really interesting is because it's a particular scenario which shows a great opportunity and where it shows you how you can execute one of these trades when volume is high, especially after a high impact event like an announcement from the Fed. So that's something that's going to be interesting from Richard to take you through. And by going through this process, by us breaking down the stuff with you and sharing this with you, what you're going to learn is how do you also use Jigsaw's tools to improve your own trading results. And you'll see how we apply some of these tools here at Axia Futures. So this isn't just theory, but it's stuff that's actually actionable and it is being applied right now in current markets by traders on our floors in London, as I mentioned, also Cyprus and Poland. So this is some shots from our Poland floor. And then this is our Cyprus floor that's recently opened. And we're opening up a few other floors, but what I'm going to do is bring on Richard Bailey now, our head of training at Axia Futures. But before I do, I'll just note that he's responsible for developing a lot of the strategies that are used by our traders. He's helped develop a lot of talent on our trading desks, has mentored many traders from junior to elite. So without further ado, please welcome Richard. Richard, are you there to take over?
I am indeed. Good to see you, Craig. Yes, I am in the London office, so good to be here. As Craig said, I'm going to go through a little bit on stats that you need to be focusing on, and particularly today with relation to at what stage in your career, because I think it's one of these things, you can always find stats and this is what you should be aiming for, but you want to sort of think about, well, where are you within your career and how are you going to progress to wherever you exactly want to be? So what I'm going to show you, and I'll share my screen in order to do this, is a little bit of a few different traders' performances at different stages within their career. Nice and simple, and what you need to be looking for there. You will see a little bit on not so much risk reward directly, but I guess risk reward in terms of trades and also win rates. Win rates are one of these things that people put a lot of emphasis on, and I actually don't think it really matters. And I'll explain that in a little bit further detail when we go and look at where exactly your performance comes from and exactly how many up days you need in a month to be able to make any money. So without further ado, let's get on with it. Right, what metrics should you be looking at? As I said, one of the things that people spend a lot of time looking at is their win rates. What I would suggest you do is ignore win rates per trade, which is the upper graph, and focus on win rate per day, the number of days that you are actually winning on, rather than the
Richard,
number of trades.
I think your screen might not be sharing.
It's not showing. Okay, let's get that back working for you guys. Thanks, Craig.
Cool.
Right, give me just a moment. Share screen. Aha. The classic mistake of not actually clicking share on the share
There we
screen.
go.
So
Nice.
there we go. Right. As I was just saying, metrics that you want to be considering. Don't focus on win rate per trade. Focus on the number of days that you actually make money on. That's a far, far better way of looking at your win rates. What I'm showing you here then is a new trader's performance. Now, I would expect this, as you would expect for anybody who's new to something, that they're not going to be able to perform immediately. And so this trader has about a 65% loss rate on trades, and also around 65% of his days are losing days. So this does not sound great. You must, I'm sure, be thinking. But this doesn't mean that this trader is unprofitable, or at least from the perspective of a new trader, is able to at least keep their head above water. And that's really the goal for the first year. The goal for the first year is you do need to focus on reducing losers, because often what happens is newer traders will start out, and in an attempt to try not to lose money, generally, what they would actually do is take quite a lot of losers in an attempt to sort of, trades looking bad, so they get out. What you're doing there is you're crystallizing losses. Now, this doesn't mean just stay in a trade forever and hope that it works. But the whole concept here then is that what you're trying to do is find a lot of trades where you don't really need to take the loss. And often it's a case where people actually have stops that are too tight, which is racking up the number of losers, which is also where you're getting some of these bigger losing days. One of the things that I tell so many people is this bottom point, that it's easier to stop doing costly things than it is to find new profitable trades. You're not going to be able to find more trades that are more profitable, but what you can do is start and get better and improve through debriefing, through assessing your metrics, where you're actually losing money. What are the trades that are costing you money? To do this, I'd just be going through all of the trades that you take and to pick out the ones that you can say there's a similarity in. Yeah, is it breakout trades? Is it reversal trades? Whatever those trades are, and work out, well, why do you need to be doing them? Or is there a way that you can not do those? So that's one of the best ways to reduce to improve your win rate, by reducing the number of losers. Another way of looking at P&L, because I think a lot of people just look at P&L on a day-to-day basis, or they look at an equity curve. Something that I think is really, really valuable to do is look at this from a distribution perspective, because the distribution of your performance is what really matters. And this will be common among all professional traders, that they will have what's called a far fatter tail on the positive side. Upside, this is a new trader in his first year, and he's achieved a 10 grand up day. He's achieved 6 to 8s, 4 to 6s on the upside, but never losing more than 3. Now, what this is meaning is that whilst that win rate on a daily basis isn't great, he's skewing his performance. One 10K up day will cover 3K losing days, and in fact a bit more, because these are between 2 and 3. So actually you could say this will cover 4 losing days. So you're getting this, from a risk reward perspective on days, sort of a 4 to 1 risk reward, if you will, in that sense. So the positive that you can take here, and this is something that you should be considering if you're in the early stages of your career, can you achieve much bigger upside compared to downside? People who can't achieve the bigger upside are the people who are going to struggle, because it's quite difficult to just very quickly reduce the number of losing trades. What you also want to be looking at is where the midpoint is. So the pink line is your midpoint. This is then showing you that the majority of his trades, or days, sorry, this is days, majority of days actually fall into the small loser. If you can just tip some of these into the small win, that makes a huge difference. And this is my point on trying to work out some of the things that are perhaps costing you money. So when we look at some of the other things that people judge metric-wise, average win, average loss, this is per day. That's pretty decent. So his average win is double his average loser. And this is the reason why, despite the fact of having 2/3 of his trades losers, he's actually still up just about. Expectancy then, the average win times the probability of win, i.e. 35%, versus the average loss times the probability of a loss, 65%, leaves him with an average expectancy of 770 a day. Now, this does not sound good, and don't get me wrong, you're not going to make a living out of this. But for a new trader in their first year, I'd be looking at that thinking, yep, that's all right. That's what you would kind of want people to do. If you can tread water for your first year, get yourself positive marginally, you're in a good place. That's where you're looking to try to get to. So where do you need to get to after that? Moving forward, 2-3 years in, you'll start to see that number of winners is changing marginally, but not by a great deal. It's the number of days that are winners that makes a huge difference here. This was 35% winning days. It's now 48. So this is a trader very similar in style, but a couple of years ahead. 48% win rate here. So what's happening then? Because he's not improved the number of winning trades. What's happened here is his ability to find those much bigger winners and capitalize on them, because he recognizes the trades better is where he's going to be making his money. So this is a trader who is much more comfortable, much better at recognizing where those big opportunities are. This way, those only 30% of winning trades count for a huge amount more. So he's using that little bit more leverage. This is what's getting him the results that he obviously wants. So what's happening here then is we're getting smaller winners are also coming along, and smaller losers. Part of the smaller losers, and this is where the distribution comes in. Smaller losers are actually relative. So it's not so much that his losers are getting smaller, because when we look at this in nominal terms, his losing trades are actually bigger than the previous trader, but relatively they're smaller because his winning trades are much, much bigger. So let's go and have a little look. What we're starting to see now then is a greater frequency of these big upside trades. So what will happen over time is as you take on more risk, your upside grows, as does your downside. So we see here, he's now taking 6 to 8K loss. That's a really bad day for him. But we're starting to see some bigger losers. That is part of the game, right? If you're going to take on more risk, if you're going to look for these bigger winners, you're also going to hit some bigger losers. But importantly, the frequency of these bigger winners and the size, 25 grand up, is very, very significant. Again, it very comfortably balances these out. The other thing that you'll notice as well is rather than there being one tall column of relatively small losers, we've actually got a couple of pretty decent small winning columns as well. So what this means is the work done here in turning, perhaps what's not a wonderful day into a slightly positive day really eats into all of this. So if you sort of think these two cancel these two bar a little bit, these two will easily cover. And in fact, this one will, well, yeah, these two will easily cover all of that. So all your money is made from this. That's essentially your money, because all the rest of them will cover each other off. That's the way you've got to try and think about your performance. So the ways in which you can improve things is either by extending the upside or by shifting some more of these small losers into the small winning category. It means that you have less to cover effectively in terms of costs. Similar in terms of average win, average loss. It's around about the double mark, slightly under double. But here you're getting an expected value of 600. Significantly, this is because of that far, far higher win rate on a day. And it's shifting that daily win rate that really makes a big difference. He's essentially taken on more risk and managed to achieve some bigger winners. So the relative or the relationship in terms of your average win and average loss hasn't really changed. So your kind of risk reward, if you will, is roughly 2 to 1 and a little bit less than that. But because you're finding a much more even number of winners, this is where you're really getting paid. So finally, let's go and look at a more established trader. This is kind of where you're going to get to from sort of year 3, 4 onwards. Again, the number of winning trades hasn't improved greatly. You're still on around about 33%, but these are really paying. So what we're now starting to see here, and that shift, if you can just shift the number of winning days you get into the positive, the difference that makes is huge, as long as your up days average bigger than your down days. Because if your up days average bigger and are also far more frequent, that makes a massive difference. So this is where you want to be trying to get to. It's a steady progress in improving the number of winning days. But one of the key bits of improving the number of winning days is firstly, not getting yourself caught out with small mistakes, trades that you don't really need to do, trades that you're taking losses on that perhaps you didn't need to take a loss on. There was actually more to that trade. If you gave it a bit more space, you wouldn't have taken the loss. That's the first bit. Then it's a case of extending the upside. You take on more risk, but you're extending the upside of the winners. You're getting those much, much bigger winners, which make a huge difference. So if we go and have a little look then at trade distribution, this is what you're then starting to see. The number of trades in the 10,000 plus is hefty. Yes, there's a few bigger losers here, but note as well with these small down days are still the most frequent, but you've got a lot of days that probably were at some point during that day a small down day, but are then turned into these small up days. But what's then happening, and this is quite important, you've got this second kind of dip and then bounce. So what this is suggesting is that essentially this is a trader who, will achieve a small up day, a small down day. This will kind of balance out over time. But when the opportunity presents for a big up day, you're not getting a larger number of slightly bigger up days. They're immediately jumping double and more very, very quickly. The 25K plus, that's actually nearly 50. So the jump there is huge, and we're getting a greater number of them as well. That's what really, really makes the difference, because now you're starting to cover off a lot of these losers very quick, and you're getting paid on far, far more big winners. As it turns out, average win to average loss, this is the worst ratio. This is only about 1 to 1.5. But the expected value, because of the number of up days being in the positive, 55%, makes the big difference. That's what's really important. It's about moving through the stages as time goes by, reducing unnecessary losers, starting to find those bigger winners by taking on more risk. And then beyond that, it's then about being able to shift a lot of days into the positive side of the winning days. You don't have to improve win rate per trade. What you need to improve is winning days. And the way that you do that is by, when you recognize a trade that is good, and it's always hard to say good, when you recognize a trade that has great potential, it's pushing it on those trades, because what you're doing there is, rather than making losses smaller, rather than trying to make losses less frequent, what you're doing is you're making them relatively smaller. Relative is such a massively important word in trading. If you can make things relatively smaller, it doesn't matter if they're growing, if your upside is growing double that at the same time. That's what really matters. So to give a little bit further example of that, we go and look at performance over July. So where was the money made in July? It's made on a few days. There's a few distinct little opportunities, and July was kind of focused around data and events at the beginning, followed by very technical opportunities towards the end. So we got the kind of usual culprits: central banks, Powell, we've got CPI, ECB. Then we had option expiry. Option expiry produced a very, very big day for a few traders. Then we get a couple of technical trades in Bund, in yen. We've then had the Beirut bombing, which produced a bit of an opportunity for some. And then you finally had this technical trade on the Fed. And what I want to point out here, this is a technical trade. Where the Fed's relevant here, so the US Central Bank, where they're relevant is they provide the catalyst. Not to say, this trade was because of what they said, but when you have a big event like the Fed, everyone's ready to trade, right? So you have lots and lots of people coming to trade. This increases volume. Increased volumes are where markets are going to move. So let's go and have a little look at how this looks over the month. Remember, I said you don't actually need many days to make all of your money. What you've got to kind of remember, if you take away these 5 days, most of the rest of the days, and you're looking at the gray here as the performance on the day. So the little grays, the blue and red is how far it went up and down. These will predominantly all cancel each other out, and you're getting paid on these big days. That's what you're looking for. And it's about maximizing these. If you don't turn the big opportunities into big winners, what you end up with is averaging out over the course of the month. So this entire month, and I actually did the maths on this, these 5 days accounted for the entire P&L of the month. So if you worked at the whole P&L of the month, it was the same, or it was matched by just the P&L from these 5 days. So this is the whole point. It's about recognizing where those big opportunities come from and maximizing those. So let's go and have a little look at top markets as well. What we've got here, and this is one of the things as well when you're looking at statistics, you would expect the markets that you trade the most to be the best performers, because these are the markets that you're taking the most trades in. Theoretically, then these should be the ones that you perform best in. And we see this reasonably consistently, that the Bund and the S&P are very, very commonly the top two performing markets for us. This instance, NASDAQ actually being one of the top performers, second most trades done in the month, was actually the third worst market. But what's really important here, and this goes back to this whole idea of relative difference between winners and losers. NASDAQ, the third worst performing market of the month. Look at how little that loss was relative to, say, yen, which was the third best performer. It was less than 20%. And that's what really makes a difference. You're making 5 times the money in this than your third worst loser. And that really sort of balances out over the course of a month. And so it makes those NASDAQ losses so small. What's also worth pointing out is the top 3 outside of the most frequently traded, gold, yen, and 5-year treasuries, none of them were more than 5% of all trade. This is where people are taking very specific trades, very specific opportunities that they've identified, and that's where they're making these ones pay. This is your kind of general workhorse trading. These are the ones, specific situations. Something's happened. There's a certain technical breakout. One of these things. So this is the whole concept of waiting until you can find that big opportunity. Where it is depends on the sort of technical makeup of markets. But in finding that big opportunity, this is where people are really finding their money. And like I said, that last day of the month was the big one, and predominantly done in gold. So let's go and have a little look at what exactly was done. This was a trade that I'd spoke to numerous people beforehand about, and numerous different traders all said very similar. I'm looking for the break in gold above 80 or above 80, 81.4. That was the level, or 81.4, sorry, 80.6 was this high. They're all looking for that break. The idea being then that on the break, we're going to get this rush back up through what was a recent sell-off. There's your sell-off in gold. And then we're looking, when this has failed to continue lower, we're now going to get this breakout up here. Nice quick move. And part of the idea behind it is, well, there's very little resistance on this. It's a move I really like. These types of moves that reasonably straight line. There's very little resistance. So you've got a few resistances in here. You've got this resistance here. That's 90.8. You've then got 96.1. And then beyond that, you've got 25.03. So they're your 3 targets on the upside. There's very little else to get in the way. So this is what makes this a really attractive trade. You've got the Fed, which brings volume in. So you've got the volume coming in from the Fed, which means if a move starts to happen, it's got a greater scope to actually run. You've then also got open space above, which means if you get into this space, there is probably about 100 ticks on at least just to get up to 90. And then potentially even about 200 or so to get all the way up to 25.03. So the technicals are there. The volume from the Fed is there. It's all there for the taking. And this is the type of trade where people do particularly well. They recognize the opportunity here and they push it on a trade like this. Yes, it was the last day of the month. This, again, was possibly your chance on the month. And you never know where your big chance is going to come. And that's something else that's always important to remember. A month is not consistent. If you're going to make 10,000 in a month, 20,000, 5,000, 2,000, whatever it is, it could all be done in the last half an hour on the last day of the month, which is what this was. And for some traders, this was by far their best trade. And in fact, for some, it actually made their whole month. So let's go and take a little look at how exactly you're going to take trade on. Remember, it's 80.6 is the key breakout point. Now, this is where you were on a 1 minute chart. From a 1 minute then, what's happened before the big move is we've actually had a little push through the level at 80.6. So what you're looking for here, this high now is 81.4. We're now looking for the break of this to then establish this next leg up. Now, I'm not going to show you the whole video because this will be around about 25 minutes of relatively steady movement. But what we're going to look at is crucially the entry, because that's the bit that matters. Once you planned your targets, well, the market's probably going there, and you can see from a technical reason why it was. We've got the volume. The blue line is the average volume for this time period. We are miles beyond that and have been for a fair bit of time. So all of that side of things, job is done. Tick the boxes there. So next is just down to the execution. How do you get into this trade? How do you manage this trade? I'll bring it up. I will sort of skip forward at one point, so I hope I get my skip right on this, but I'll give you a little sense of what's going on. So here we go. This is then gold. Now, one of the things that I'd be looking for in a trade like this, we know where the high is, up at 81.4. You know what the previous level was at 80.6. But look here where most of the volume is. Most of the volume is below 80. So what I'd be interested in is, rather than waiting up here where everyone else is going to try and get in, if we get above 80, be quite happy to try and get in there. What this gives you is a preemptive position. If it fails now to break the high, or it just skips through the high and rolls back, you can give up on this, and you'll probably still give up for a small winner. But if you wait and try and buy it through the high, you run two risks. One, it ticks through the high and rolls straight back, you're going to lose. And two, if it jumps very, very quickly through the high, you're going to miss it because somebody else has got in ahead of you. As it's happening, it's actually sitting right at the high. Now we've jumped. That jump is really useful because that's shown now this surge up. It's not like the previous break where we traded just through 81.4. This is now a far more significant break. So we're now in a great place. We've got the jump up through the 81.4 high. You've got some low volume, and I always talk about low volume on a ladder. This shows you that jump in price. And crucially, we're above the 81.4. So all is good. So the idea of the trade then was to try and add on back down in the sort of low 82s. Yes, it's a bit above the level, but you're taking advantage of this light volume to act as support, as well as the previous high, which is also acting as support. Note, by doing this, your average price is still below the level. Don't get me wrong, it's probably unlikely that if this falls back through 81.4 that you're actually going to be able to get out for a winner, but you're not looking for the winner there. But you're not going to be taking a significant loser. If it drops below 81.4, you want out of this, get out of the trade. At this point, we're starting to drift up, build more volume higher up. This is all looking good. It may not be flying up the page like people might have hoped, but it is moving in a way that you'd be quite happy with. So now it is just a case of, I know I emphasize this so often to people when we do any kind of training. This is a case of you've made your plan. You know what you want to do. You know where you think this is going. What you don't know with any trade is precisely what that journey is going to look like. So if you don't know precisely what the journey is going to look like, you don't know exactly how we're going to get there. That's not a problem. As long as you know where your stop is, which is going to be below these previous highs. I'd actually have it below 80. Below 80.6 just to be sure. So I'd have my stop at about 80. The volume's building, that's all good. We're actually now at this point in the middle of this phase here. And this is where it can feel a little bit tedious. But remember, we've still got around about 50 ticks to go until you reach that first target. That's the target up at 90.8 up here. So what I'm going to show you, I won't show you the whole video, as I said. But one of the things I do want to show you is how do you deal with a trade that goes nearly to target, but not quite there? Because that's always something I think people get stuck with, and then they end up getting out of the trade when it starts to come back on them. And you'll see this in a little moment. We pushed up towards 87.9. And one of the other things is when you're in, a market can fluctuate a lot further back on you than you perhaps would ideally like, but the journey is still going. That's the thing to remember on a trade like this. So the target now is 90.8. We're still continuing to tick up. So still trading 88, flick back towards 87. It's all looking okay. We're ticking up on the journey there. We've still got around about 20 ticks to target to go, at least to the first target, that is. So it's still sitting at 88.8. And this is where you can get quite frustrated. You're like, come on, do it, do it, do it, do it. And people get sort of tempted to go, oh, it's only 25, 30 ticks away. I'll take it. That's $300 a contract. Don't take it. Now, what you've just seen is that sudden jump. Sudden jump got within 6 ticks of your target. This is where you don't sit around hoping that it's going to keep on going. A sudden jump is a great indication that people have panicked. Either this is a stop set off or people have panicked to try and rush in for the next bit of the move. Typically on a panic, this is where the market will take a pause. It will roll back for a period of time until you can find new buyers. Remember, this has just gone up over 100 ticks reasonably quickly. So people aren't going to keep on buying and buying and buying. So that jump was the panic. Get something out, take some profit on this one, and then wait. There was no news on that. I just saw a question, was there any news? There was no news on that. That was just a market that had traded up, and it effectively push, and creates a jump. This was at around about 8:30, so not the end of the day either. So what we've now done is try to buy some more on the way back, 87.2. The reason for the 87.2 on the way back is that we've now started to stabilize. So I'm always looking, when I'm trying to play a pullback, my assumption here is market's going to roll back and stabilize, and then we're going to go again. So the goal then is, can we get in at 87.2 for the next leg towards the upside? I then at this point have a stop down just below 85. So at that point, you're then locking in your winners. You're going to be up 3 lots out at 85, plus one of them's got out at 90. You're happy with that trader. Get my stop in, step back and wait for the market to play out. Your next target, of course, is 96.1, which it does around about 10 minutes later. I'm not going to show you all of that bit because obviously it's going to get pretty dull watching this for another 10 minutes to drift its way up. One of the important bits there was the execution in and then using that spike of volume to scale out, to take a bit of profit and then try and add back to your position at lower prices. So there we go. Hopefully that helps people in their execution going forward. You're using the information you get from the ladder along with the technical breakout to give you the chance to leverage up on the trade. Try and extract that one big winner. If you can do that on 3 lots and carry it 150 ticks, it's nearly about $4,500. That's a huge amount to take out of this market. And it's a great end to your month. If you do it on more, then you're going to take even more out of it. So there we have it. A bit on stats, what you need to be looking for, and the emphasis, particularly when it relates to stats, is the relative difference between losers and winners. Not about keeping winners small. It's about taking more risk, but getting those relatively big upsides. Right. I'll bring Craig back in. I know Craig's probably been monitoring for some of the questions. We can do a little bit of Q&A now. So if people do have any questions, throw them out there.
Yeah, exactly. So we'll stay around for a little bit to do Q&A, but there was a question here, Richard. First, I guess, asking what the news was, and yeah, also what the difference was between the first break and the second one. There were 2 points that you identified in the trade there.
Yeah, I saw the question about the first break and the second. If I just share my screen, I'd be interested to know on this. If you can, if you can tell me like the price of those two breaks, because from, excuse me, my perspective on this, there was only one break because the break was above the big level.
I
This
think
one here.
it was when you were getting in ahead of the level getting broken. So I preempting the break versus then once you get the jump.
Yes, I see. So when we got this, so we got in just before the break down here. So that was the first part of the trade. To try and get in down there. Whoops, maybe draw a little bit big. Getting down here and then add when we got in here or when it jumped through the high. Now, the idea behind that is that when you get in preemptively, I want that extra information that says my preemptive idea is now actually good. Because buying it down here at about 79, 80 area, when you buy it down here, this could not work. This could just do this and roll back down. Now, if that happens, well, I'm not going to lose a great deal because it's going to trade over the highs and then it's going to fail. I'm out. Once it breaks the level, now I can be confident that this is actually a solid idea. This trade's going to work. And this is the key to being able to extract more out of a trade. It's being able to look at this and say, okay, I'm now in a situation where I'm right and I need to leverage. I need to add on to the trade. And by adding here, after you've got that confirmation, you're still only pulling your average price up slightly. So your average price is still around these previous highs, but you've got that confidence that this is working. And so now you can try and stay in the trade. I hope that's kind of answered the question for you on that one.
Yeah, I think that
And I
makes
hope I
sense.
also have my screen shared, which I believe I
Yeah,
did.
yeah, you do.
Just see a couple of different ones. Do a trade the same chart timeframes for different markets. The way that I approach chart timeframes is I have two. I have an hourly chart and a 5 minute, or that could be a 1 minute dependent upon volatility. And I'd have that for pretty much everything. The idea here is that the hourly gives you context. That gives you the where could we go? And that's the whole idea behind that move. The short time frame chart, in this instance, a 1 minute, gives you the where exactly am I going to get into the trade? It allows you to have more precision. It allows you to also reduce the risk that you're taking on a trade. Rather than just buying on an hourly and trying to use an hourly level for a stop, you can do it on a 1 minute and use a very short time frame stop. If you're buying it at 80, absolute maximum stop you're going to need is down here. And that's going to be about 40 ticks. And I'd say that's even a bit too much. If you're buying it above 80 here, I'd actually perhaps only be looking down here for my stop. That I'm buying it on a break. I expect this to actually go immediately. If it doesn't go immediately, that's part of the clue that this trade isn't a great one. When you get that big jump, especially from news, how do you establish a pace to join the move? I've seen in the past where you discuss volume profile and join at low volume nodes. Yep, absolutely. That was part of the idea of the execution on this. They actually produce a little low volume pocket here on the move up at around about 80. Now, in doing that, what that shows you is that buyers have completely taken control. As they completely take control, theoretically, they're going to defend this. Yeah, if they're willing to buy everything in that little red zone there, or little circled zone there, they're not going to let this come down and not buy more. Equally, anybody who sold it in here is now going to want to try and get out. And if they can get the chance of a scratch down here, they're going to try and take that. So that's the whole concept between the low volume holding the market up. So that's where you want to use that to try and enter above the low volume and use the other side of the low volume as your stop. So it's got to get through that. It's got to get through that to get you out.
There's a question on do we not trade DAX at Axia?
In general, why are you not trading DAX in Axia? Reason being, the DAX has lost a lot. When I first started, I started in 2007. When I first started, DAX was my main market. The problem, I guess, that the DAX has encountered is because it's got a very high tick value, it's 25 euros a tick. As price has gone up, the swings that you get in the DAX are very, very large. But on top of that, they've also brought in the mini DAX contract. So what's happened is the volume that was all traded in the DAX used to do 120,000 contracts a day, has now split. So what you've now got is 65,000 in the big DAX and 55,000 in the small DAX, or 60, 65 and 60, somewhere around that. So, or the mini DAX. So what this means is there's less liquidity in both. So neither of them trade with the same degree of flow that the old DAX used to have. And that's why a lot of people don't trade it anymore. The other thing is the S&P has become much smoother and much quicker, a bit like what the DAX used to be like. So that's a big factor in it.
There's a question from Casey. What are some metrics you look for in traders' stats to start getting them to trade more size? And how do you think through encouraging them to add through their execution? Yeah, there's a bit more. But yeah, I guess maybe the first part just on the what we look for in the stats to trade more size.
Yeah, so I think one of the things that I really want to start to see for traders to start adding more size, and you don't need much on this, and just to point that out, if someone's got a positive expectancy, so take that newer trader, he's only got a $7.70 positive expectancy, but what he is doing, or what he was able to do, and I just ping it back up to the top there. There we go. What you're seeing is that he can recognize when there's a big opportunity and can recognize and increase size on that. So what you could suggest is this wouldn't be a bad time to actually increase size, because what would then happen is this would significantly improve the upside. Because if you're doing this on double the size, this goes from 10 and becomes 20. Yes, your losers are going to get a bit bigger, but the thing is, the relative relationship between losers and winners is far, far more skewed to the bigger side of the winners. That way, by increasing size, you're actually going to increase those winners far, far more. If you double this loss and it becomes 6, but double this win and it becomes 20, the difference in nominal terms there is massive. So that would be one of the ways that, or one of the times that we'd actually encourage people to upsize. One of the times that you wouldn't is when somebody's had like one particularly big day. You know, something completely out of the blue comes, someone takes a really big winner, their equity jumps, and then they increase size. What I would say to that is that's something that is outside of the norm. And if anything fits outside of the norm, that's where you don't want to increase size, because chances are this isn't because your trading ability has massively improved. This is more because you found one very anomalous situation that produced an extremely anomalous performance. That would be where I would suggest not increasing size. When it comes down to sort of encouragement for these types of things, one of the other things that I would always point out to people is, because we risk manage a lot of traders, we speak to them. There is that element of saying, you're doing right, you're doing well at the moment. This is the time to start pushing. But the other thing is to be aware that in getting used to trading more size, almost everyone will get a period where, if you look at somebody's equity curve, when they increase size, it will have been going up, they increase size, and it will do that. It will trade sideways for a bit, and then it will continue up. This phase is the phase where they're getting used to trading that bigger size. And that's what's going to happen there, because they're going to take some bigger losers, but they won't always get the bigger upside because they'll scale out quicker. Once they're used to the bigger size, then they'll go up. So what I would suggest as well is you give yourself a drawdown and you say, right, I'm here, I'm going to increase size. And if I get my equity to here, I'm going to reduce the size back down, but give yourself the chance. Right, I've seen a fair few more starting to pop up. Right, I might not go into the specifics of this one. I would generally suggest that a volume jump is not sufficient to get me into a trade. So you're looking at the volume jump here. That volume jump, the reason that I would not take that on as a buy is because volume has increased right into the level and then not gone through it. So what this tells me is buyers have just failed in doing exactly what I'm looking for them to be able to do. So that's absolutely where I do not want to be in this trade. I want to be in when the level breaks, not buying it when the volume picks up and then falls off into the level.
We take maybe one or two more questions.
Yeah, one or two more. Very quick on tools to track your metrics. They're all taken from Journalytics. So use Journalytics, which is provided through Jigsaw, and then you can then extract some of those onto Excel.
There was a question about what markets are preferable to trade futures in intraday, and then maybe one more to add to that is I guess prop firm challenges online. Like, what's your opinion on them?
Right. Okay. I don't think that there is a better market to trade than any other. Don't get fooled told that you should trade S&P or NASDAQ or Forex or whatever it is. I'd suggest this to anybody. Go and trade a few different markets on a sim and look for markets that you feel comfortable in. Look for markets that the way they move feels like it makes sense to you. The way it moves, you kind of understand it. It feels right. Some people like faster markets. Some people like slower markets. The best market is the market that you're most comfortable and you feel you understand the most. That's how I would do that. Online prop firms, unfortunately, most of them are set up in a way that they make their money from you failing and resetting. So they are set up and skewed towards people actually not passing. And even when they do pass, they're very restrictive and make it very easy for you to then still lose, with the view that, or with the aim that you will then have to reset and pay them again. So their game is effectively taking as little risk of real money as possible, and many of them are sim only, so it's not even real money. They're doing that in an attempt basically to make the money off resets. So I'm very, very dubious of online prop firms personally.
Cool. Well, yeah, I think with that, I don't see any other questions there, Richard, unless you've eyeballed a few that you still want to answer. But yeah.
Yeah, excellent. Well, if people do have any specific questions, they want to ask anything a little bit more, info@axiafutures.com, we can cover off any of those questions there as well.
Yeah. And if you have enjoyed this workshop with Richard, we do tend to do at least one of these per month. We don't have a date set yet for the next one, but there will be another one in September. So just keep an eye out for that if you're on the Axia email list. If you're not on the Axia email list, just head over to the website and you'll see you can register for one of our webinars there. It says register for the webinar. You can sign up for our list through there to just keep in touch with what we do. But other than that, yeah, just keep an eye out for the next one that we'll be doing within the next couple of weeks. We'll make an announcement. But otherwise, yeah, thanks, Richard. It's been an awesome session.
Awesome stuff. Right. Good being here. Good speaking to you guys. We'll speak to some of you very soon.
Awesome, guys. And yes, a replay will be sent out. So just keep an eye on your inbox. You'll receive that within the next 12 to 24 hours. All right. Thanks, guys.
Thanks, guys. Take care.
Cheers, Richard. Bye.